Subscribe to my channel Report Stock.
Have you ever found yourself wondering how a company, especially say a tech company, actually manages to pivot? How they push forward in a market that's just changing incredibly fast, often driven by AI, right? And how do they manage that balance between making these, well, audacious bets on the future and, the immediate demands of the balance sheet? Well, today we're doing a deep dive into exactly that kind of story. We're focusing on LCFY Limited. They're listed on NASDAQ, ticker LCFY. They're a globally recognized software as a service company, SaaS, the model, delivering software online via subscription, and their specialty, location-based digital marketing solutions. So our mission today is really to unpack Locify's fiscal 9-month period, the one that ended March 31, 2025, and we want to highlight the pretty bold strategic shifts their management believes are laying a strong foundation for, well, significant growth in fiscal 2026. We're going to see this really fascinating contrast, I think, the immediate financial performance versus some really significant operational advancements they've made. Our goal is to help you get a handle on what all these moving parts mean for a company that's betting big on AI and these strategic partnerships.
That's exactly right. And for you listening in, this exploration is, well, it's about understanding a pretty universal business dilemma, isn't it? The delicate balance companies always face. Investing heavily in future growth, especially in something as high stakes and fast moving as AI, while, managing today's financial results. It's a classic tension. So we'll explore this through two main lenses. First up, we'll look at their, let's call it operational momentum. So it covers their strategic partnerships, the product innovations, particularly AI-powered stuff, and the new ways they're actually going to market. Then second, we'll dig into the financial reality. The reported revenue, the expenses, the net loss, all those key indicators for this 9-month period. Locify's CEO, Gavin Burnett, actually put it quite well. He said, and I'm quoting here, "We believe our achievements over the past 9 months have reshaped Locify's position in the market." Okay. He really sees them building what he calls a strong foundation to scale. So as we talk through this, I'd encourage you to think about how these two pieces, the strategic progress and the financial outcomes, how they really weave together to tell the full story. Are they building an orchard or just planting seeds right now?
That's a great way to put it, an orchard or just seeds. Okay, so let's unpack the operational momentum first, because it sounds like there's a lot going on there, and it's almost all focused on, well, building for that future harvest, like you said. Locify's been incredibly busy on the partnership side, right? They've signed these multi-year high-value agreements, not just in the US, but also in the APAC regions, Asia-Pacific. That's a huge, fast-growing digital market. And these aren't small deals, apparently. They come with really large-scale deployment potential. It sounds like they're trying to plug into other people's networks.
Yeah, and what's really interesting here is this very deliberate, very strategic shift. They're moving towards what's often called a partner-led go-to-market model. Now, this is absolutely key if you want scalable, high-margin recurring revenue. So instead of building out these huge, expensive sales teams everywhere, they're essentially plugging into channels that already exist. For example, just after this reporting period ended, so in June 2025, they signed a pretty significant strategic agreement. It was with a leading US-based online reputation and review management platform. Now, that partnership alone is set to expand Locify's U.S. listings footprint by about 10,000 end users. And they're specifically targeting a premium segment, think real estate agents, mortgage brokers, high-value clients.
Okay, so it's not just about adding volume. It's about getting inside these existing high-value ecosystems where clients are already, engaged and spending money. And they're not stopping there, right? They're integrating products too.
Exactly. This partnership also sets the stage for Locify's AI search-ready landing pages and engagement tools. These are planned to be offered as value-added upsells. Now, you might ask, what makes a landing page AI search-ready? Well, it basically means these pages aren't just optimized for the old way, traditional keyword searches on Google. They're specifically built for how AI search engines think: ChatGPT, Perplexity, Gemini, how they process, understand, and then present information. This could make a business dramatically more discoverable, more relevant in this whole new search landscape. It offers a real, tangible edge to their clients.
That's a really crucial distinction. It shows they're not just like reacting to AI, but proactively building for it.
Yeah.
And speaking of AI, in July 2025, they officially launched their big AI-powered SEO product suite with something called Localizer as the flagship product, right? How does that fit in?
Oh, Localizer is absolutely central to their product strategy. It's engineered, they say, to drive rapid local and national search visibility. Across Google, Google Maps, and crucially, those leading AI search engines you just mentioned, they've even integrated a tool called Article Accelerator right into their platform. This is for in-house article creation and publishing. It's all about boosting content in line with Google's latest SEO policies, EET and all that, helping businesses create fresh, relevant content at scale, which is just increasingly critical for ranking well. And it's all automated and optimized by AI.
So the AI isn't just some, fancy add-on. It's really the engine driving their core offerings now. Have they seen any early wins from this AI-driven approach? Any proof it's working?
Absolutely. And this focus on AI, it's not just talk, it seems tangible. They developed an AI-driven prototype for localized business articles, basically using existing directory content to generate unique, high-quality pieces automatically. And the early tests showed pretty impressive results, actually. Page 1 rankings within just 30 days for these AI-generated articles. Now, that's an incredibly rapid time to value. That's critical for clients, right? They need quick results in today's online environment. And there's more. Also, in July 2025, they secured an exclusive APAC syndication partnership for Experience.com's platform. That's an enterprise-grade review management platform. So this move cleverly integrates SEO with reputation management, creating another anticipated long-term growth channel across Asia-Pacific. It's about building that comprehensive digital presence.
Okay, and you mentioned localizer gaining traction. The source material gives some really concrete examples of how quickly these partnerships are ramping up. In August 2025, so very recently, they signed 2 significant U.S. digital agencies. One focuses on the insurance sector, another on home services. Plus, they partnered with an Australian agency serving multi-location clients in similar sectors over there. And these partners aren't just signing up, right? They're expected to use Locify's U.S. and Australian business listings database to drive really targeted leads for their own clients and the revenue generation from these deals. Expected to start very soon, September 2025, with significant scalability potential, they say.
Yeah, and just to give you a clearer picture of that scalability potential, think about this. They specifically highlighted a national SEO agency partner that has a dedicated 10-person call center, ready to start selling Localizer from September 2025. Imagine the kind of direct sales power and market reach that gives them instantly. And another partnership they mentioned is with a digital marketing group serving a leading national insurance network, a network that has thousands of locations across the country. So yeah, these are not small-time deals. These partners provide immediate, pretty much unparalleled access to large, targeted customer bases. It lets Locify scale far more efficiently than if they had to build all that sales infrastructure themselves. It's a really smart leverage play, actually. Focuses their capital on the products and tech. Oh, and they even signed another deal in August 2025 to manage business citations for over 1,400 locations across Australia. This was for an Australian top 50 enterprise, basically ensuring all their business info is consistent and accurate online, crucial for local SEO. Another recurring revenue stream there too.
Okay, so we've heard about this ambitious roadmap, the AI-powered products, these potentially massive partnerships, all strategically designed for future revenue. And importantly, many of these launches happened after the March 31, 2025 reporting period we're technically focused on. It's clearly a very aggressive strategic push. But now let's shift gears a bit. What was the immediate financial reality during that 9-month period ending March 31st, 2025? Because this is often where you see the short-term pain of a heavy investment phase.
Absolutely. And the financial statements for that specific 9-month period, they do tell a different story for now. Total operating revenue came in at $2.4 million AUD, that's Australian dollars, which is actually down from $2.9 million AUD in the same period the year before. And if you break that down a bit more, subscription revenue, which is usually the key metric for a SaaS company, that predictable income was $2.2 million compared to $2.6 million previously. Advertising revenue also dipped from about $213,000 down to $117,000, and services revenue dropped quite a bit, from $126,000 to just $47,000. Although it's worth noting, the prior year's service number includes some consulting fees that were apparently revised down later. So yeah, there's a clear dip in that top-line revenue during this transition time.
Okay, so revenue was down while they were pouring resources into building all this new operational momentum we just talked about. How did that filter down? What about expenses and ultimately the bottom line?
Right, operating expenses tell a really significant part of the story here. And this is where you need a bit of nuance. They actually increased to $6.2 million AUD, up from $5.2 million in the comparable period last year. However, and this is a really critical detail, this $6 million figure included a substantial one-time $1.4 million share-based payment expense. Now, this wasn't cash actually leaving the company. It was related to shares they issued, basically in recognition of liabilities that were converted into equity. So essentially, instead of paying out cash for certain obligations, they issued shares, which helped the company preserve its cash and also maintain its NASDAQ listing compliance.
Ah, okay. That's a huge clarification then. So if we sort of mentally strip out that non-cash strategic payment, what does that tell us about their actual underlying operational costs?
Well, if you exclude that one-time adjustment, the operating expenses were actually $4.6 million for the period. So this adjusted figure shows a decrease, primarily driven by lower employment costs and lower marketing expenses.
Oh,
It was partially offset by slightly higher tech expenses and depreciation and amortization, which you'd expect. So while the headline expenses look like they increased significantly, a big chunk of that was actually a non-cash accounting adjustment. It was part of a strategic financial move to shore up the company's position, rather than just a big spike in day-to-day spending.
That is a critical nuance. It shows they were managing cash flow quite creatively. But even with that adjustment considered, the net loss for the period still went up, didn't it?
yes, it did. The net loss of the period came in at $3.5 million AUD, or 2.1 times per share. That's a higher loss compared to the $2.1 million, or 1.63 per share they reported in the year-ago period. So despite some efforts to manage those operational costs and that strategic non-cash payment, the dip in immediate revenue combined with the ongoing investments, it still led to a higher net loss for this specific reporting period. Their monthly recurring revenue, MRR, for the fiscal third quarter ending March 31, 2025 was $261,000. Now that was up 1% sequentially from the previous quarter, which is a small positive sign, but it was still down 2% year over year. So it shows maybe a slow but steady sequential recovery starting in their core subscription business, even while the overall numbers reflect this broader transition they're in.
Okay, but here's where it gets really compelling, I think, on the financial side. Despite that increased net loss, despite the heavy investment, their cash position actually improved quite dramatically. At March 31, 2025, LCFY significantly boosted its cash and cash equivalents to $12,286,175. That's a pretty substantial jump from just $275,875 at the end of June 2024. What drove that big increase?
Yeah, that increase was largely down to proceeds from issuing shares. It's on stock, basically. That brought in $3,259,448 over the 9-month period. So they were actively raising capital, bringing in new investment by selling shares, which makes sense. They needed it to fund these big strategic initiatives we've discussed, to maintain their NASDAQ listing, and just to make sure they had enough liquidity, enough cash on hand to actually execute these aggressive growth plans. It's a pretty classic move, really, for a growth stage company in a capital-intensive area like AI and software development.
Okay, right. Let's try and bring this all together then. You can really see this deep dive shows us a company that's firmly in a major transitional phase, making some really big bets for the future. LCFY is aggressively pushing this growth strategy. It's centered on AI-powered SEO solutions like their flagship localizer product, and it relies heavily on these high-value partner-led distribution channels, especially focusing on the US and APAC markets. We heard those specific examples like that national SEO agency with the 10-person call center ready to sell localizer, and that digital marketing group serving the huge national insurance network. Their ambition seems crystal clear: gain significant market share, and then ultimately move towards sustained profitability. However, the immediate financial snapshot for this fiscal 9-month period ending March 31st, 2025, it starkly reflects that investment phase. Remember, those big operational initiatives, the AI product suite, the major partnerships, most were launched after this period in July, August, September 2025. So the reporting period itself showed that decrease in total operating revenue down to $2.4 million from $2.9 million a year before.
Yeah.
And an increased net loss of $3.5 million compared to $2.1 million previously. And this really underscores their strategy, I think. Despite that net loss, the company significantly boosted its cash and cash equivalents to over $1.2 million. And that was largely thanks to raising nearly $3.3 million from issuing shares. It really is a snapshot of a company deliberately, burning cash now to fuel what they hope will be a big surge later on.
And that's exactly the broader implication here, isn't it? LCFY's strategy, it plugs right into this wider trend we're seeing everywhere. Businesses rapidly adopting AI, using complex partnership models to try and achieve scale. The increased net loss, the higher operating expenses, even when you adjust for that big one-time share-based payment, the underlying expenses were still substantial. That's highly characteristic of companies in a heavy investment phase. It's particularly true when you're developing cutting-edge AI tech and building out these extensive partner networks. Those are costly things to do before they start generating significant returns. Look, this approach represents a calculated risk. It's a deliberate sacrifice, really, of immediate profit for potential future market dominance. So it makes you think, as more businesses like LCFY lean heavily into AI and these complex partnership models for growth, What are the key indicators we should be watching? I mean, beyond just the immediate revenue figures, what will truly signal long-term success? Should we maybe be looking more closely at partner engagement metrics, or perhaps early AI adoption rates among their actual clients?
Maybe the conversion rates of those AI search-ready landing pages. And the big question is always timing. How quickly can these ambitious strategies, like Blockify's plan to start generating significant revenue from September 2025, how quickly can that translate into the kind of sustained profitability that companies are ultimately aiming for? There's a question that really defines so much of the modern digital economy, I think, and definitely one worth keeping an eye on.
Subscribe to my channel Report Stock.